So good evening, everybody. I am Dr. Dheeraj Jain, and this webinar that is there that I will be conducting this webinar on the overview of mutual funds. Before me starting with the webinar, I'll just talk a brief about my own self. I'm Dr. Dheeraj Jain. I finished my PhD long back, and I'm a professor at NISM. The subjects that I take is security analysis, portfolio management, financial derivatives, quantitative techniques in finance. These are my subjects. I have six students who have finished their PhD under my guidance. I am a little bit interested in research, and my experience is more on markets rather than academics. Briefly talking about NISM that I work for, National Institute of Securities Markets, is a public trust that was established in 2006 by the Securities Exchange Board of India, which is the regulator of the securities market in India. And we have a wide range of capacity building activities at various levels aimed at enhancing quality standards in the securities market. So our focus of studies, webinars, programs that we have, whether it is a long-term programs or whether it is a short-term programs, whether it is faculty development programs, management development programs, student development programs, exchange programs, for postgrad students, for short-term courses, everything is focused only towards the securities market and the financial markets that we see. This is our broad area in which we work. Everything will be only related to the securities market, and we are very specialized in the securities market. How will this particular program, this webinar on mutual funds that I'm just going to talk, mutual funds in itself is a very big industry. So I will just be broadly giving you the the outline of how this presentation is going to go. I'll be talking about the investment landscape, exactly what is investment landscape. I'll talk about what a mutual fund is, what is the structure of a mutual fund, what do we mean by an asset management company, how do they work, the classification of mutual funds based on the structure, based on the investment objective, a little bit about risk and return, categorization of mutual funds, and how we can invest in mutual funds. What are the different kinds of options? If I'm able to cover what are the different kinds of options. Now, talking about this mutual fund industry, if I talk about this mutual fund in an industry at large, here the money that is managed by mutual funds, that figure is called as the assets under management. We call it as AUM, assets under management. The overall assets under management of the Indian mutual fund industry as of March 31st, 2025, it is the latest figure that is there, is something about 65.75 lakh crores. If I say 65.75 lakh crores, it's something nearly of 40% of the total bank FDs that are there in the banks. This is number one. This total assets under management that I'm talking about has grown from 22 lakh crores, that is in 2018. September 30th, 2018, it was something on 22 lakh crores. Today is something, it is of something about 66 lakh crores. So if you can see, this figure has from 22 lakh crores to 66 lakh crores, which is a six. It is something about three times increase in the past 2018 to 2025. That is in the past 7 years, they have increased by something about three times. This is total AUM that has increased. The mutual fund industry has got. If you talk about the folios, if you talk about the account number of the folios that are there in the mutual fund industry, it's something around 23.5 crore folios. The total number of accounts or folios, by the end I've told you, this is the total number of folios that exist presently in the mutual funds. Okay, so when we talk about why investing in mutual funds, and when we're talking about mutual funds, if you invest in the capital markets, if you invest in the stock market directly, there are various challenges that you will be facing. Number one, what is the challenge? What is the first challenge that we'll be facing when we invest in mutual funds? Number one is the time. Not everyone has got the expertise. Not everyone has got the time. You might be concentrating in your profession, I might be concentrating in the profession. We don't have the time to keep on watching the market day in and day out in order to understand when to invest, when not to invest, when some kind of some kind of news is going to come, which kind of news is going to come, which kind of information might be positive, which kind of information might be negative. The first challenge that we invest in the capital market directly is time. Second is expertise. Not everyone understands. It is very difficult for us to understand or have the expertise relating to the variables that influences our returns in the capital market. Not everyone is comfortable. Not everyone will understand. if there's something happening in the US economy, Indian markets will be affected. There's something happening in the Chinese economy, Indian markets will be affected. If some political turmoil is happening in India, the markets will be affected. If there's something happening in a particular company, then the performance of the stocks or the performance in the capital markets are affected. So when you talk about the expertise, not necessarily everyone has got the necessary expertise to invest in the capital markets. This is point number two. Third is a lack of information. We though we have Google, we have Chat GPT, we are connected to the internet almost 24 hours, but even then, lack of, the information that we need to take decisions to invest in the capital markets directly is actually lacking. It's lacking across, not in some particular specific sector, but across. This information we might have access to Google or to all the sources of information, but even then there is a serious lack of information relating to the factors influencing the performances in the capital markets. Point number four, the fourth challenge that we all face when investing in capital markets is portfolio. We retail investors have limited money. If I want to invest, I might be having limited money. That limited money, with limited money, I can only buy limited stocks. If that stock will perform, very well said done. If that stock does not perform, I start, that is my investments in that particular stock is not fruitful. But let's say, for example, I always invest money in a particular pool. You will also invest a money in a pool. Third person will also invest a money in a pool. Fourth person will also invest. So when all the investors invest their money in a particular pool, the pool becomes big, and that pool can now create a portfolio and can invest across the market. Each and every sector is not going to perform at the same time. There will be some sector which is going to perform at some time. There will be some sector which performs at some time. There will be some sector which performs at some time. Different sectors are going to perform at different times. Sometimes infrastructure is going to be very good. Sometimes FMCG is going to be very good. Sometimes retail is going to be very good. Sometimes banking is going to be very good. So when we create a portfolio, they create a port when the fund manager creates a portfolio from the pool of money that they have got, then they can invest across the market and take the benefits of all the sectors that are performing, or a specific sector that is performing. Now when we are retail investors have got limited capacity, and we can invest only at some particular, because our the total money that could be invested is less. Hence our limitation, we have a lot of limitations. But moment the more the money goes into a pool, it is invested across the whole market, and we get benefits out of this, out the growth in the market. And last but not the least is the volatility. The market is highly volatile. When I say volatile, many of you might have studied statistics. That is, it is called, we calculate volatility using standard deviation. When I say volatility, means we do not know tomorrow the market is going to go up or is it going to go down. We are subjected to a huge amount of volatility. The US president will say something, the market will move in one particular direction. The Indian Prime Minister will do something, the market will move in some direction. There will be something happening across the whole world, the market is going to move in some direction. RBI will give some statements, market will move in a particular direction. There will be a budget, the market is going to move in some particular direction. There might be some attack, some kind of uncertainty, the markets will move in some particular direction. So when I talk about volatility, the performance of the stocks in the market is highly volatile. It's highly volatile. So when we as retail investors take an exposure into the capital markets directly, we are these are the challenges. That is time, the expertise, the information, portfolio, and volatility. These are the various challenges that we as investors face when we are investing our money directly into the capital markets. Okay. So when we talk about this, when we have to put our money into the markets, when we invest, how do we evaluate our investments? When I say how do we evaluate our investments, means when we are investing our money into the market, we need to evaluate how are the returns, how are we getting the returns, and we are supposed to evaluate. Is my screen visible to everyone? Yes.
So it is visible. If you could please put it on the PPT mode. Participants are requesting the.
Okay. Now is it visible to everyone? Now is it? I have put it in the PPT mode. Is it visible to everyone?
So it's not visible in the PPT mode till now. Is it? Yeah, yes, sir. It is clear now.
No, it is clear, means what? Is it visible now or is it not visible?
It's visible, but we are not able to read the font as such. But anyway, you can go ahead.
Okay, just a second. Slideshow. If I put it on the slideshow, will you be able to see it? Set up a slideshow presentation. I put it on the slide. Now I think it should be visible. I've made it full screen, so it should be visible to everyone.
Okay.
Yes or no?
Participants are asking to zoom in a bit, I think.
Okay, you want me to zoom in a bit? Okay, now is it okay? I've zoomed it.
Better. Better, sir.
Every one of you, because I have only one screen to see, so either I shift the screen. So I'm sharing one of my screens. I have not shared my whole screen. I'm sharing one of the screens. So is my screen visible to everyone? Namrata, can you just confirm, is my screen visible to is my screen visible?
So it's visible.
Okay,
Yes,
okay,
sir,
good,
is
good,
it
good,
visible?
good, good, good. Okay. So, what are the factors that we need to consider for evaluating our investments? Number one is safety. Okay. When we invest our money, it is not that we invest our money and we don't care about the safety of our principal. It's very, very important that the money that we are investing, how safe is our principal, right? We have to ensure that the principal, that the money that we are investing, minimum that has to be safe. Second point that is important is the liquidity. Whenever you want to remove your money, are you in a position to are you in a position to withdraw your money? If you're not in a position to withdraw your money, then it's of no use. That is, let's say for example, real estate. Now I invested my money in real estate. I bought a piece of land. Let's say I'm just taking a hypothetical example. I bought a piece of land, let's say worth 10 lakh rupees. Over a period of 10 years, the value of the land has gone up to 1 CR. But I want only 20 lakh rupees. Will I be able to sell away the land? It becomes difficult. When will I able to be, when will I be able to sell the land? Will I be able to sell only a portion of the land for 20 lakh rupees? Will the land that I sold be tax efficient? Will the land that I sold be I would will I be able to liquidate it or get the money when I really want to? There are serious challenges to liquidity. If I talk about real estate, if I talk about various other investment options, let me talk about investments in equity directly. If I have a blue chip stock, if I have a stock which is very, very popular across the whole market, then it will not be a problem for me to sell the stock. I will tell my broker to I punch in an order for selling, and I can sell the stock immediately. But let's say, for example, I have some kind of a penny stock. I have a company stock which is not very, very popular. And if I want to sell it, even if I punch in an order, may or may not be, I will be able to sell the particular stock. So whenever we are investing in the market, it is very, very important for us to understand whether our investments or the returns that we are generating will be able to convert, will we be able to convert it into liquid or not, and into liquid or not, and as fast as possible or not. When we talk about returns, of course, there are various investments other than mutual funds which will give you very good returns. But will you be able to encash it, exit when you really want them to? What are the returns that they are giving? Real estate is giving you good return. Equity is also giving you return. Mutual funds are giving you return. There are various other investments options also that are giving you return. But those returns are going to come with some element of risk. How much risk are you willing to take for generating those returns? Point number four for evaluating investments is convenience. Is your investment the convenience of investing? How efficiently can you put your money into those investments? Let's say, for example, I have invested money in a particular mutual fund scheme, and tomorrow I get transferred to Delhi or I get transferred to somewhere in Assam, and if I want to exit and if I want to remove my money back, I can go there, I can remove my money. I can go to a particular mutual fund asset management company's office. I can punch in my order and I can get my redemption. The fees that we that the fees that the fees that we need to pay, the transaction costs that are there, is very, very less in case of mutual funds. When you talk about the ticket size, when I say talk about the ticket size, how much minimum money could have been invested? If I talk about real estate, probably today in India there is no piece of land, there is no place, there is no real estate property. If I want to invest just 50,000 rupees, probably there is no piece of land where I can buy for 50,000 rupees. But if I want to invest in mutual funds, from February 2025, even as small as 2 lakh 250 rupees can be invested in a mutual fund scheme. There are schemes which allows the smallest of the investor to invest and put their money into a mutual fund scheme and get the returns that equity markets are actually giving to the investors. So the ticket size in mutual funds is very, very low. Minimum investments is very, very low in case of mutual funds. It used to be very, very high. In mutual funds, it was minimum used to be 5,000. It came down to 1,000. Then it came to 250. You can just imagine, as small as 250 rupees, people can invest in mutual funds. The taxability of the income. Now, whatever incomes you are generating, whatever returns you are generating, you also have to see the tax part. how tax efficient are the returns? If you put your money into a bank FD, there will be a tax on the interest. If you put your money into real estate, there will be some kind of tax element over there. If you put your money into post office investment schemes or the small savings investment schemes in post office, there will be some kind of taxability. If you put your money into equity mutual fund, there is some kind of taxability. If you put your money into debt mutual fund schemes, there is a kind of taxability. So you have to understand what are the tax components or the taxability of those incomes that you are getting out of those investments. And naturally, but not the least, the tax deductions. Now, let's say, for example, if I put my money into a bank FD, any interest above a particular limit, the bank is going to cut a TDS. It's called as tax deducted at source. But in mutual funds, there is nothing called as tax deducted reserves. These are the various factors by which we as investors evaluate our investments. So when you talk about safety, when you talk about liquidity, when you talk about returns, when you talk about convenience, you talk about ticket size, you talk about the taxability of the income, you talk about tax deductions, probably mutual funds are able to give you the best of all of these factors that I'm talking about. When you talk about the horizons where mutual funds can invest, there are different kinds of asset classes where mutual funds can comfortably invest. The different kinds of asset classes. I talked a lot about real estate. Naturally, we all understand. Many of us understand real estate properly. So, real estate, it's very very popular investment option. Equities are very very popular investment options. Commodities have come up as an investment option. Not everyone understands commodities. Not everyone understands equity very well. Fixed income. There are fixed income securities which are also very good asset classes and they give you very very good returns, but it's very very difficult for we as retail to understand all these different kinds of assets, because all these different kinds of assets do give very good returns, but they have their own respective characteristics. Okay, so now when we talked about all of these, let's come back to this small story, that is what exactly is a mutual fund. As in the beginning only I told you, mutual fund is a common pool. It's a common pool where all the investors put in their money, all the retail investors, whosoever are the investors, and this common pool has told that we are going to invest the money of the investors according to some stated objective. They have given their objective right in the beginning, that we are going to invest the money of the investors according to a common objective. This is our objective. XYZ could be an objective. The objective could be investing only in FMCG. The objective could be investing only in infrastructure companies. The objective could be investing only in gold. The objective could be investing across the market. The objective could be investing only in large cap stocks. The objective could be investing only in small cap stocks. Whatever is the objective, that objective has been stated before. The objective is given to the investors that this is the objective, and if the investors objective matches with the objective, the stated objective, that investor can invest their money in that common pool. That common pool invests the money in the market according to the stated objective. Whatever returns are generated from the market are transferred back to the investors. This is the simplest logic or simplest understanding of a mutual fund. Anyone who has some kind of surplus or who wants to invest in in the market, according, he or she might be having some respective objective. On the basis of the objective, you can select a particular scheme in a mutual fund, put the money, give the money to that particular pool. That pool is going to invest the money according to the stated objective. Whatever returns you will get from the particular investments, that returns will be transferred back to the investors. The mutual funds in India are registered as trusts. So mutual funds are not companies. Mutual funds, the only thing that mutual funds get will be their own respective fees. They don't have anything called as profit sharing. They hold the investors' money in a fiduciary capacity. We use the term fiduciary capacity. Fiduciary capacity means the beneficial owners of the mutual fund, of the benefits from the investments are the investors. Mutual funds are only the fiduciary owners. When I say fiduciary owners, means they hold the units on behalf, they hold the assets, or they invest on behalf of the investors. Mutual funds do not give assured returns. Please remember, they will not give assured returns. They will not guarantee, okay, I'm going to give 25%, I'm going to give 30%. Mutual funds don't give assured returns. They will give you market returns. And over a period of time, it is time and tested. Over a period of time, market returns have always been better than assured returns. Simplest understanding of a mutual fund, it's a pool where investors put in their money. The pool has stated their objective prematurely, that this is going to be their objective. Investors put in the money in the pool invests the money in the market. They generate returns from the market and give the returns back to the investors. The returns are market returns, they are not assured returns. Please remember, I'm putting force on this particular statement that the returns are not assured. No mutual fund is going to give a guarantee. Take my word, if there's any scheme which ends up giving a guarantee, then in that case, that particular mutual fund has to tell their investors what is the guarantee behind, what is that particular investments behind which they are giving a guarantee to the investors. In the long term, as I told you, mutual funds will always perform better, the market returns will always perform better than the assured returns. If I broadly talk about the historical returns that mutual funds have generated since the past 25, 30 years, I've been in this industry since the past 30, 32 years. I have seen that minimum, at least I have seen 12 to 14% returns on an average the mutual fund industry has comfortably given. There are various schemes which have given much more than that. There are many schemes which have given less than this, but on an average, investors can get comfortably 12 to 14% return, and this return is a return which is able to beat the inflation that we all are exposed to on a daily basis in our country. Because our country is a growing country, so we will always face inflation, and mutual funds will be able to cover up this inflation. Okay. Now this mutual fund, of course, you if you understand mutual funds, now I'm just giving you an overview. If you all understand mutual funds, very well said on. If you don't understand mutual funds, then it is also good for us to take the benefits of mutual fund performances through the distributors. There are there are large number of distributors in the market, mutual fund distributors in the market, who are registered, who have qualified the relevant certification examinations from NISM, and they are SEBI registered mutual fund distributors, and you can take their advice and then accordingly invest in mutual funds and reap the benefits of the returns that mutual funds generate in the market. Okay. Now, whenever we are investing in mutual funds, now as I told you, these were the key considerations. I told it before also. In mutual funds also, this is important. Naturally, liquidity of your investments. Liquidity. How fast can your investments be converted into cash? This is number one. How convenient is it for you to invest? That is, what are the documentation that is needed, what are the connectivity that is needed, how can you invest, how can you disinvest, how can you do a redemption, how can you adjust your investments according to your needs. If you are moving from one place to the other place, then how will your investments, how can you do your encashment or redemption of investments? What are the returns that you're getting? And post tax returns, we just don't talk about returns, it is post tax returns. What are the post tax returns that you get out of mutual funds, and what is the safety of your investment? These are the major considerations that we all have to have in our mind before investing our money into mutual funds. So broadly, if I talk about the circle of this investment, we are the investors. We put the money in a common pool. We give that common pool gives the money to a fund manager. The fund manager invests the money in the stocks and securities in the market. They generate the returns, and these returns are given back to the investors. This is the simplest. This is the simplest cycle of mutual funds. That is, if you can take an exposure, and honestly speaking, with my past experience, I can just tell you that it is very good for us to go to a mutual fund distributor and do our investments, or to invest our money into the financial markets through advice, through mutual funds, because even for the mutual funds also, the expense ratio is very less. Let's say, for example, at the maximum you'll find a mutual fund scheme whose expense ratio might be at the maximum 2%. Normally the expense ratios are less than 2%. At the maximum we'll end up seeing an expense ratio of 2%. If expense ratios are 2%, that means mutual funds are managing your 100 rupees and they're only charging you 2 rupees for managing 100 rupees. Not a bad deal. If you can get your 100 rupees managed by spending only 2 rupees as an expense, it's not a bad deal. And that 2 rupees will be charged to the will be charged to the scheme, and it will not be charged to you separately, so you will not come to know exactly. Of course, it is charged to your performances only. Your performance would have been better had the expense ratio not be charged. But this expense ratio is to meet out all the other expenses for handling the whole scheme, for the brokers' fees, the bankers, you have the registrar and transfer agents, you have the asset management company who are going to take their investment management fee. So it is the whole infrastructure that has been provided to you at a maximum cost of the expense ratio. That's the maximum cost. Okay. So when we talk about all of these stories, now this is the broad structure. As I told you, you have the unit holders. Now, because in India, now here you have a term. Now here, if you see, I hope you're all able to see my screen properly. Now here you have something called as unit holders. If you see over here, you have unit holders. You have a mutual fund, you have asset management company, and you have trustees. And then you have custodians, sponsors, and transfer agent. I'm going to talk about all of these. They're all important. Now we the investors are the unit holders. Now why in India mutual funds are registered as trusts? Please remember, mutual funds in India are not registered as companies. They are registered as trusts. So when they are registered as trusts, they cannot issue shares, they will issue units. That's the reason why the investors in mutual funds are called as unit holders. This is point number one. So investors are unit holders. Now these unit holders give their money to a mutual fund. Now this mutual fund is managed by, because mutual fund is a trust, so it is managed by the trustees. Had mutual fund been a company, it would have been managed by the board of directors or a director or a CEO or a chairman. But because mutual fund is a trust, it is managed by the board of trustees. You have the trustees who are responsible for the performance of the mutual fund. Now this mutual fund will now appoint an asset management company. This asset management company is the operational phase of a mutual fund. This AMC that I'm talking about, asset management company. So you as an investor or me as an investor, whenever we go to an office of a mutual fund, we are actually interacting with the asset management company. We are not interacting with the mutual fund, because the asset management company is the operational phase of the mutual fund. When I say an operational phase, means the asset management company, whatever you interact with, whomsoever you are going to interact with, is only the asset management company. Now you have the asset management. So I talked about the unit holders, that is the investors are the unit holders. I talked about mutual fund. It is a trust. It is managed by the trustees, and then you have the asset management company. So the agreement between the mutual fund and the asset management company. You have the mutual fund, you have the asset management company. The agreement between both of them is called as an investment management agreement. That means unit holders give their money to the mutual fund. The mutual funds give the money to the asset management company. The asset management company invests the money in the market. They generate the returns from the market and gives the money back to the unit holders through the mutual fund. This is how the simple logic works. It's as simple as that. Then you have this asset management company now will appoint a custodian. All the activities of the mutual funds are broken down separately. This asset management company is going to appoint a custodian. Now, who is a custodian? In whose custody? A custodian or a depository is one in whose custody or deposit in whose custody are the assets held. Now, this AMC is going to invest the money in the market through the broker. Asset management company will have a number of brokers. There are number of regulations, they have number of brokers, and those brokers will buy those shares. When the shares are bought, the shares are not kept with the asset management company, the shares are kept with the custodian, the shares are kept in the depository. So this is one player. The custodian is one of the players. The trustees are there, the asset management companies are there. Then you have the sponsors. Now who are the sponsors? The sponsors are the one who set up the mutual fund. The sponsor will set up the mutual fund, then he will appoint the board of the trustees, he'll take the approval of SEBI. Once SEBI approves the board of trustees, then the board of trustees will appoint the asset management company along with the sponsor. Then the asset management company now will appoint the broker, will appoint the custodian, the registrar and transfer agent, the bankers, and all the other participants who are there in this particular whole structure. So you have the custodian, you have the sponsors, you have the transfer agent. Now here you have the transfer agent. This transfer agent is also the registrar and transfer agent. Now who is the registrar and transfer agent? All the interactions with the investors, all the interactions with the investors is done by the registrar and transfer agent. Now, what are the interactions with the investor? The investor wants to put in more money. The investor wants to do a redemption. The investor wants to do a KYC. The investor wants to do a change of address. The investor wants to do a change of bank account. The investor wants an account statement. So these are all the operational or the administrative activities that the investor wants. So the whatever interface that is there with the investor, or whatever interactions is there with the investor, whatever services the investor wants, that services are provided by the transfer agent. This transfer agent may also be called as the registrar and transfer agent. If you see the structure, probably you will come to know that they are also called as the registrar and the transfer agent. So you have this is the broad structure. So you have the unit holders, you have the mutual fund managed by the trustees. Then you have the asset management company. There's an agreement between the mutual fund and the asset management company. This is called as investment management agreement. You have the custodian, you have the sponsor, and you have the transfer agent. This thing also is the same thing. You have these trustees, so I'm not going to go with this slide. Let's go to the next one. Okay, let's not even take up this. Now I hope you all have been able to understand the broad structure. As far as Though if you start entering details, you could still delve deeper into details. I'm not delving deeper into details. I'm just talking about the broad structure. Up till now, are you all there with me? Is my screen visible to everyone? Yes. If you could just please confirm. Is my screen visible? Good. Okay. Now let's talk about the different kinds of mutual funds. Now if you today, if you see 65 lakh crores, if you can just visualize in the year, I don't remember the exact number, but in the year 2003 or 2004, when I had entered into the mutual fund industry, the total assets under management was hardly 24,000 crores. Now you can just think the total assets under management, the total money that mutual funds used to manage in the year 2002, 2003 was hardly 24,000 crores, and today it is 65 lakh crores. So much amount of money has been given to by the investors to the mutual funds to invest across the different segments of the market, across different kinds of stocks, across different kinds of financial instruments. Mutual funds will come out with newer and newer schemes, newer and newer ideas, newer and newer themes, newer and newer methods by which investors could invest. So there are different kinds of mutual funds. What are the different kinds? Let's do this classification of mutual funds. What are different kinds of mutual funds that we all broadly understand? It's only broad, okay? I'll not delve deep. I'll only talk broadly. The different kinds of mutual funds. First is by constitution. You can classify the mutual funds either by constitution or by the investment objective. When I say a constitution, now let's say for example the room, my cabin that I am sitting in over here, this cabin that I am sitting in over here, if I want to divide this cabin into if I want to divide this cabin into three different parts, I can divide it laterally, I can divide it diagonally, I can divide it vertically, I can divide it different methods. Similar way, the mutual fund world or the mutual fund industry can be divided, either the mutual fund industry could be divided on the basis of the by the constitution of the mutual fund, how it has been constituted, or it could be divided by the method by investment objective. What is the investment objective? Let's try to understand this whole structure. So either when we talk about constitution of the mutual fund, it could be classified either the mutual fund could be a closed-ended fund, it could be an open-ended fund, or it could be an interval fund. We're just understanding broadly. What do I like? I'll try to tell you what exactly a closed-ended fund be, or an open-ended fund and interval fund be, or by investment objective, equity fund, debt fund, and cash fund. Prob this particular classification by investment objective is very popular. Everyone understands, okay, equity fund, there could be an equity fund, the name itself says it will invest only in equity schemes. A debt fund, it will invest only in the debt products. And there's a cash fund, that this cash fund, there could be various kind of categorization of these cash funds. So there will be some element of equity, some element of debts. In some there will be equity will be more, debt will be less. In some equity will be a little bit less, debt will be more. So there are different kinds of combinations, or you can say the combination of equity and debt could be hybrid. So there are different kinds of hybrid funds, that is by the investment objective. So you have equity funds, you have debt funds, and then you have this cash funds or the hybrid funds and so on. The classification, that this is a very broad classification. If I start breaking down the classification, it will not even be able to, I'll not be able to describe them on this whole slide. Overall 65 lakh crores getting managed, and there are totally 44 mutual funds today, and all these 44 mutual funds combined have floated nearly 9,500 schemes in the market. Nearly 9,500 schemes. So you have 9,500 schemes that are presently there in the market, which are managing nearly 65 lakh crores. Each and every month, nearly $2.5 billion are getting invested. When I talk about $2.5 billion, it is something around 22 to 25,000 crores that is coming into the mutual fund industry every month. Every month, you can just imagine the magnanimity. And this is still only 23 crore portfolios. It is only maybe hardly 11 crore investors out of a total 140 crore people. We are only 11 crore people have invested in mutual funds. So if you talk about the possibility of the industry becoming bigger, I do not know how much scope we still have to be become how much scope we still have, how much bigger we still can be. Okay. So we talk about by the constitution. What do we mean by a closed-ended fund? The name itself says closed-ended fund, open-ended fund, and interval fund. So what does a closed-ended fund mean? A closed-ended mutual fund scheme is a scheme where the scheme is open for a particular period of time. Let's say, for example, the scheme is open for 15 days. Investors can put in the money in that common pool in those 15 days. Then the scheme gets closed for a period of time. The scheme may be closed for 3 years, the scheme may be closed for 5 years, it may be closed for 4 years, depending upon what their objective is. Let's say I'm just taking a random example, the scheme is closed for the next 5 years. Now, in the next 5 years, the scheme is not going to accept any further money from the investor. The scheme was open, investors put for 15 days, investors put in their money. Now the scheme is closed for the next 5 years. After 5 years, the scheme again opens, and now it becomes an open-ended fund. The scheme opens, and now the investors want to take in their money, they can take in their money. More investors want to put in their money, they can put in their money. But now here there's a catch. In a closed-ended scheme, if there's an investor who has invested his or her money, and if they want their money back after, let's say, a random example, if they want their money back after 4 months or after 6 months, they have got some problem at their home, and if they want their money back in between, how does it? Is there a window? Now, these closed-ended schemes that are there will always try to provide an exit window to the investor somewhere in between. So if the scheme is closed for 5 years, I'm just taking a random example. The scheme will open a window. They will say, okay, every 3 months, on the first Wednesday, or every third month, first Wednesday, I will open the window. If the investor wants to, if the existing investor wants to take their money back, they can take their money back. They will not allow fresh investments to come in. The mutual fund scheme is not going to take in fresh investments, but if there is an existing investor, if that investor wants to take their money back, they can take their money back. It will be open only on that Wednesday. Then again, the scheme gets closed. Then again, after 3 months, again the first Wednesday, the scheme will again open only for that one day. If the investor wants to take their money back, they can take. But the scheme is going to charge a penalty or an exit load because the investor is taking their money back before the closing of the closed ended portion of the mutual fund scheme. Because mutual funds take the money from the investors and they invest the money in the market, so they might have some objective behind investing. And if the investor is exiting before that particular objective is being met, naturally it creates a kind of administrative hurdle for the asset management company, and henceforth they charge an exit load to the investor if the investor removes their money before the closing of that particular scheme. So in a closed-ended scheme, the scheme opens for a particular period of time, it remains open, investors can put in their money. Now the scheme is closed for the next period of time. The scheme could be closed for 3 years, it could be closed for 5 years, depending upon what their objective is. And again it opens, and then again it remains an open-ended fund. This kind of a scheme is called as closed-ended schemes. This kind of scheme will always will be floated by the by AMC in the market only when the volatility in the market is very very high. If there's some kind of a serious problem in the market, like in the year 2008 financial crisis. In the year 2008 financial crisis, there was not it was not just the volatility, there was a serious lack of trust in the market. When there's a serious lack of trust in the market, no one knows what's going to happen. That is a point of time when mutual funds will say, okay, you can put your money into the scheme, we will close the scheme for the next 3 years. So that kind of we will not be exposed to the kind of volatility that we might see in a short period of time. Only when this high level of uncertainty exists, that time the mutual fund schemes try to bring out closed-ended schemes. So we talked about the closed-ended scheme. Let's talk about the open-ended scheme. What do you mean open-ended scheme? It is open. It is again very very popular. Whenever the investor wants to invest the money, they can bring in the money. Whenever the investor wants to exit, they can exit with that necessary when they invest their money, whatever will be the net asset value. Like you have the share price in the market, similarly mutual funds have got a price which is called as NAV, net asset value. This net asset value is calculated on the basis of the total assets minus the liabilities, whatever is there, divided by the total number of units. They will calculate their NAV. Now this NAV that is there, any mutual fund unit will always be will always be reflected on the basis of their net NAV. That is the net asset value. You will not see rupees. You will see a net asset value. You will not. This is the, or you can put in a layman's language. You can put a net asset value, or NAV is the price of that particular one unit of the mutual fund scheme. Next is the interval scheme. Now, what is an interval scheme? Closed ended. It was closed. It was open for a period of time. Then it is closed for a period of time. Then it remains open. Open ended scheme is always open. Interval scheme is a kind of scheme which is in existence only for some particular period of time. Let's say, for example, there's a scheme. The mutual fund manager, the asset management company fund manager identified some investments, some stocks or some fixed income securities in the market, and he found that these instruments are going to mature in some period of time. I'm just taking a random example, going to mature in the next 44 days. He found out these are the treasury bills, these are the government securities, these are some certificates of deposit, and these instruments are maturing in the next 444 days. And the price at which these instruments are getting traded, if I buy these instruments today, probably I'm going to get a yield, the return of something around 7.9% or 8.9% or something like that. That in fund manager, and the scheme will be open only for some interval. What is that some interval? Maybe the scheme will be open only for 1 day, or the scheme is open only for 2 day. In this 1 day or 2 day, whatever money the fund manager will get, he will take that money, he will close it, and then he'll invest that money into those instruments. He'll buy those instruments, and the scheme now is closed for those 444 days. I took an example of 444 days. After 444 days, those instruments will be redeemed. He will not sell the instruments in the market. They will be redeemed because certificates of deposit treasurable, they get matured and the government will give the money back. The schemes will be the instruments will be redeemed and the returns will be given back to the investors. Interval funds are normally compared. The performance of interval funds are normally compared to the performance of the bank fixed deposits. So, if you talk about the different kinds of mutual funds by constitution or by investment objective, they could be equity funds, they could be debt funds, and they could be cash. By constitution, they could be closed-ended funds, they could be open-ended funds, and they could be interval funds. This is the broad classifications. I told on the structure open-ended, closed-ended, interval based on the objective debt, equity, or cash or hybrid. And nowadays, you also have this kind of style is also becoming very very popular on the investment style. Passive funds and active funds. Now, I'll try to explain what do you mean by passive funds and active funds. Now, this is very, very though understanding it is very, very simple. We just need to know what they are. What do we mean by passive funds and what do we mean by active funds? Okay, so let's take up active funds first. In the name itself says active. The fund is very very active. That means in this particular scheme, the fund manager who is managing the fund is very very active. He hires the research team. He does a lot of research. He buys stocks. He sells stocks. He does a lot of trading, and he tries to beat the benchmark. When I talk about mutual funds schemes will always compare their performance with some kind of an existing benchmark. The mutual funds will never say, okay, I have given this return and this is the best possible return. They have to compare their performance, the scheme performance, with an existing benchmark. They will tell you the benchmark right in the beginning. What is their benchmark? What is the benchmark against which they will compare their performance? So you can have active funds. An active fund is a fund where the fund manager always tries to beat the benchmark performance, some benchmark that he or she has said, and they will try to beat the benchmark. They're very very active. They'll do a lot of research. They will buy, they will sell, they'll keep on trading. Their expense ratio is going to be very very high. It is a style. The fund manager has got his style, and he or she is very very active. But there's another kind of this one fund manager who is passive. He says that, come on, yeah, I don't want to do so much headache. If I say Nifty, there are 50 stocks in the Nifty. If I take some standard benchmark, let's say BSE 200 or Nifty 100 or Nifty 200, whatever is the benchmark. If they, let's say, 200 stocks, the top 200 stocks of the Nifty, 50 stocks of the Nifty, 200 stocks of the Bombay Stock Exchange, the top 200 stocks of the Bombay Stock Exchange, top 100 stocks of the Bombay Stock Exchange. The index is there. The performance will again be compared to the benchmark, but they will always try to replicate. When I trade, they replicate the benchmark, means they will give the returns according to the benchmark. The benchmark will give 20% return. They will try to give 20% return. If benchmark had given 30% return, sorry, 25. Are you all able to listen? Are you able to see the
So we
presentation?
are able to listen, but your PPT is no longer visible to us.
Why is it visible?
No, so for the time being, like
Is
one
it
minute,
right now? Is it visible?
no.
I don't know why it is not visible. I'm connected. It is my full screen.
Uh,
I'm on full screen.
Shri Ganesh, please can you intervene and just check?
Sir, a kind request like stop the share button and again you can share, sir. One time unshare and you
I
can.
stop the share button first. You mean to say, do I stop the share button?
Can you
No, wait.
reshare it again, sir?
I share it once again. Okay,
Yes, sir. We will have tried.
I hide it. Is it visible?
Yes,
Yes, sir.
sir.
Now
Okay, whenever it is not visible, let me know. Just because for me only one screen is visible to me, I am not able to see the other screen. So either I see my screen, I see myself, or I see the PPT. That's all. So I should at least know if my PPT is not visible, let me know about it. Okay. Okay, so I told you about active funds and I told you about passive funds. Now this is the broad logic about the active funds and the passive funds. Nowadays, passive funds are becoming very popular because everyone says, okay, if you understand the market very good, you can go towards active funds. If you don't understand the market, don't take headache about active funds. Invest in a passive fund. If the index grows by 10%, probably your fund will also give nearly 10%. If the index grows by 20%, your fund will also give 20%. Index grows by 15%, your fund will also give nearly 15%. Very good. I'm happy with that. That is, an investor should be happy with that. Right. Expense ratio is going to be comparatively less. Okay. For a first time investor, if you have already invested in mutual funds, naturally you might have some kind of knowledge about mutual funds, and you will try to do a little bit more. But if you are a first time investor, invest only in passive funds. Go to go pick up some kind of a passive fund and put your money into that passive fund. Don't take much headache. Okay. So I talked about this structure. I talked about the classification of mutual funds on structure, on the basis of investment objective, on the basis of style. So the open-ended, closed-ended interval is done. Equity, hybrid, and all is done. Passive funds, active funds are done. Um, I talked about the same classification I've already done. Now, different kind how money can be invested in a mutual fund scheme. So either if you have one time money, so there are two methods by which investment can be done. Either it is lump sum investment or it is through systematic investment plan. Now this SIP nowadays is very popular. Lump sum investment is one time investment. You have one time money, you can put your money into the mutual fund scheme. Whatever returns you will get, the return the it will be reflected through the NAV, and you can take your necessary returns. That is one time investment. The second is through a systematic investment plan, which is today the most popular method of investing. Systematic investment plan is not a scheme, it is a method of investing in a particular scheme. So let's say, for example, a person is getting a salary of something about 25,000 rupees. I'm just taking a random example. 25,000 rupees. He takes a systematic investment plan of 5,000 rupees. So every month, 5,000 rupees shall be deducted from his account, and he would have specified some kind. He would have specified some kind of a scheme in which the money should be invested, and the money goes away from his account and gets invested in that particular scheme. And over a period of time, this is systematic investment plans have a capability to give exceptional returns. They are able to give exceptional returns. These are through two methods by which money can be invested. Either the money can be invested lump sum, it is called as lump sum or one time investment, or the money can be invested through a systematic investment plan. Okay. Now there are different kinds of options that are available in mutual funds. Whichever scheme that you have 44 mutual funds, you have more than 9,000 schemes, you have lump sum investment, you have one time or a systematic investment plan. Now you have different kinds of the options that are available. So first kind of option is a direct mutual fund. What do you mean by a direct option? Direct option is an option. Let's say, for example, you understand mutual funds on your own. In that case, if you understand mutual funds on your own, you don't need to go through an advisor. You can always invest your money into a mutual fund scheme directly. You can go to an AMC's office, a register and transfer office, transfer agent's office, and invest your money directly. If you understand mutual funds, if you understand the market, you can select the scheme on your own, and you can go and invest on your own directly. If you don't understand, you can always go through an advisor. If you go through a registered mutual fund advisor, then that person is going to make you invest in a regular scheme, in a regular option. So in that case, your investment will be in a regular option. So you have a direct option, you have a regular option. Then you will have other options also. So one option is so now here you have growth. Now I'll talk about these options. So you have a growth option. In growth option, you will have a regular option also, and you will have a direct option also. So you can invest in direct growth, you can invest in regular growth. If you don't want this, you can also select an option which is dividend payout. Mutual funds can also give the returns of the scheme through payout option. That means they will declare during the month of March whatever returns they might have generated, they will declare a dividend, and the dividends can shall be given away to the investors. That option is called as a dividend payout option. So if you want to select a dividend payout option, that is also there. The dividends will be declared, the dividends will come to you, but the dividends can again get reinvested in the market. So you also have dividend reinvestment option in mutual funds. So these are the different kinds of options that are available. It is not possible for me to delve deep into each and every option, but you can broadly understand, either you have growth option. In growth option you have direct option or regular option, or else you can have a dividend payout option where every year you'll get a dividend, or you can have a dividend reinvestment option where the dividends that you get will get reinvested in that particular scheme that you are specifying. Okay, so these are the different kinds of options that are available. These are the two kinds of documents that an investor has to see. One is statement of additional information, the other is scheme information document. The name is telling you something. The scheme information document. The scheme information document, that is the SID, is there, will be there with the application form of the mutual fund. The scheme information document will contain all the information that is necessary for the investor to invest in a mutual fund scheme. That's called as SID. The scheme information document contains all the information that is necessary for an investor to invest in a mutual fund scheme. The statement of additional information will contain all the other information relating to that mutual fund. So, scheme is for a mutual fund scheme. Statement of additional information is for all the other additional information relating to that particular mutual fund. The scheme information document will be something about 250 to 300 pages. If you want any information relating to that scheme, what is the scheme, who is the sponsor, what is their ideology, who is the investment manager, what is the performance, etc., 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 all asset allocation pattern, what is the strategies, what is the liquidity, what are the fees, expenses, what are the other information, anything relating to that particular scheme, you will be able to get in the scheme information document. Okay, so these are the broad. This is the broad outline of the mutual funds. Now when the mutual fund when you invest in mutual funds, naturally returns are there. So there are different kinds of returns. What are the different kinds of returns that you can get? That returns, it is for us to, what you can say, decide which kind of calculation we want to do for assessing our returns. So mutual fund, depending upon the regulatory need, depending upon when the investor has invested, depending upon when the scheme has been launched, the returns can be simple returns. The calculation can be simple returns. The calculation can be annualized returns. The calculation can be compounded return. The calculation can be the CAGR. CAGR is compounded annualized growth rate. So compounded annualized growth rate is a return you will always see when you are investing through a systematic investment plan. What are the norms? The SEBI has given certain norms to the mutual funds, and they have to reflect their returns only according to those respective norms. They cannot show absolute returns wherever they want to. They cannot show simple returns wherever they want to. They have, when should they show annualized returns, when they should they show compounded returns, should they show CAGR. These are all shown by mutual funds to the investors on the basis of guidelines clearly specified before. There are different kinds of risks of investing in different kinds of funds, naturally, because depending upon the kind of scheme that you have invested. If you have invested in a completely liquid fund, the performance will be according to will be compared to the performance of a savings bank account. Returns will be less, risk is also very less. But if you invest in a specific theme, you invest only in infrastructure, you are investing only in some particular sector, the risk of that sector performing will also be high, but at the same time the probability of the returns is also going to be very, very high. Okay, so broadly this is what I wanted to talk, though there could be a lot that I could talk on mutual funds. This is broadly what I want to talk. Now I would like to take up the questions that you have relating to whatever I've been able to say, or any queries that you have. If you can put it on the chat box, or let me see the chat box visible. Can you revise passive funds as you, just a second. First, let me take up this. Can you revise passive funds as you were not able to? So, passive funds are those mutual fund schemes, passive funds, which will not do a lot of research. They will pick up benchmark. They will see the proportion of the stocks in the benchmark, and they will invest only according to the same proportion that is there in the benchmark. They will not do their own research. They will not break their own heads. So their expense ratios are comparatively less. They will not buy sell actively as normally active funds do. Okay, that is what a passive fund is. Okay, any questions that growth option dividend, so which is the best? No, all the options. So this Shubham Chopra has asked this growth option, dividend payout option. All the options are equally good. If you are a long term investor, let's say for example you are investing for the next 20 years, you don't need dividend reinvestment or dividend payout option. You go invest for a growth option. Okay, could you explain the structure again? See, structure just for me as for you as an investor, we are not bothered about who the sponsor is. Okay, that is there in the scheme information document. You will get it in the scheme information document. But for us, it is more important that the sponsor sets up the mutual fund. The mutual fund then appoints an asset management company. The asset management company is the interface to the investor. The investor interacts with the asset management company and invests the money. The money goes to the pool. The pool invests the money. Returns are generated, and the returns go back to the investors. Okay. Can you tell me? Okay, just a second. The list is going very fast. I'm not able to catch. How exactly should I invest? If Shamshad Rangres, how exactly see how exactly should you invest? If you are able to understand, fine. If you are not able to understand, go and visit a mutual fund distributor. He will tell you. You'll have to do your KYC first. So it is also there eKYC. Also, you can go to the website and do the eKYC. Also, Google out eKYC. You do the eKYC, then you pick up a scheme. You can go to moneycontrol.com. You will have a large list. Where do you want to invest? If that is difficult for you, visit an advisor, ask an advisor to come to you, take the advice. He will advise you properly to invest in mutual funds. Okay. Okay. What could be the right portfolio? It's very difficult for me, sir, to tell you what is the right portfolio. It is all your objective, financial objective. What is your objective? Okay. Passive uh, can you suggest any mutual fund so that we can start investing less amount and can learn more from it? See, suggesting a mutual fund scheme from the platform of NISM, I cannot suggest you scheme number A or scheme number. Pick up any mutual fund scheme. There are 44 mutual funds and they have totally 9,000 schemes. I cannot specify one scheme. There are a number of schemes in the market. You think, what is your horizon? Let's say, for example, 25 years is your horizon. Pick up any mid cap fund, pick up any small cap fund, pick up any large cap fund, any flexi cap, multi cap. There are large number. My suggestion to you is ask an advisor to come to you. He will come to you, he will explain to you, he will see your risk profile, he will do a risk profiling of yours. He will see what is your risk bearing ability, what are your objectives, and accordingly he will that advisor is going to suggest you how you could invest in those particular schemes. Okay. Is demat mandate to invest in mutual fund scheme? Rakesh Kosal. No, demat is not a mandate. No, you don't need a demat. Can we get this PPT? Yeah, there's not a problem. That it will be shared with you. Which mix of funds could be better? The mix of funds depends upon your objective. Depends upon your objective. Sir, I thought it was 2,500 for a mutual fund scheme. No, the minimum in February 2000 on February 24th, State Bank of India had come out with a mutual fund has come out with the minimum amount to be 250 rupees. So the lowest amount that can be invested today in a mutual fund scheme through a systematic investment is 250 rupees. Okay, so that is will small cap be more beneficial? Maria Mukherjee. Yeah, small cap is beneficial if your objective is a long term. It's long term. If the objective is long term means there is no exact definition for what a long term could be, but long term, according to me personally, should be at least minimum more than 10 years. Okay. Okay, capital gains tax. Yes, capital gains tax are there on mutual funds. Short-term capital gains are also there. 364 days, less than 364 days, you have short-term capital gains. More than 364 days, you have long-term capital gains. As is mid-cap investment safe? If you are, yeah, Shraddha, mid-cap, there's nothing called safety. You're investing in the market. You're taking a market risk. You will get market returns. Your horizon is long. They are comparatively safe. Is it? But it. But sir, what about SIPs? I could not. If someone invests, yes, yeah, through a systematic investment also you can invest in a through a systematic investment plan. All investment also you can invest in small caps. Okay. Yeah, the questions are going very fast. I am not able to see the questions so fast. How is the NAV calculated? It is what's the name here? How is NAV calculated? Lalit Vishnu. See, NAV, there's a method of calculation in NAV, just Google it out. Otherwise, if you open the scheme information document, They will tell you how they calculate broadly. What is the net asset value? Whatever asset the mutual fund has today, whatever stocks or financial securities they have, they will that is the asset, the value of the assets. They will subtract the liabilities divided by the total number of units that they have already issued. That will become the net asset value. That's the calculation. It's something like if you are a student of commerce, it is a calculation of the book value. It's the method of calculation of NAV is similar to the calculation of the book value. Okay. 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 As an investor, yeah, the questions are moving. Sir, as an investor, what are the five things we should see while researching in mutual funds? Researching in mutual funds, you see your investment horizon, you see your risk-bearing ability, you see how much you can deploy. Longer the time period you go, better it is. What is your risk-bearing ability. You see what is the risk-bearing ability, and comfortably invest in a mutual fund scheme. Don't worry. You see, if you are able to understand, very well said done. Otherwise, take the advice of a advisor. He will be the best person to advise you on investing in schemes, in mutual fund schemes. If you can understand, if you can do a necessary homework, you can take an exposure directly. If you take an exposure directly, the returns are going to be better than the returns that you go through other routes. But you have to do your necessary homework. I have invested in mutual funds 25 years back. Then I should congratulate you. If you have invested in mutual fund schemes 25 years back, I can surely see that you would have made a significant amount of return that no one in this classroom would have been able to think of. If it is 25 years back, the index was hardly something about 10,000 or something. Today, the index has gone up to 80,000. So you should be actually partying because you would have made a significant amount of money. Yes. Namrata, there are still a lot of questions. I don't think so I'll be able to take up all those questions. The questions are coming out very fast. How long will it be beneficial? How long will it is beneficial? It is beneficial. How long? Up till either you decide an objective or let the money remain invested, and whenever the returns keep on coming, you want to encash it. Whenever you feel that you should be able to encash, you should always. Can you please explain what type of return of course can ex- what type of return should we focus on? What type of returns to learn more on the can you please explain what type of return should we focus in? Returns you should focus on means in so that we learn more and to gain more experience. Vishal Dubey. What kind of returns to focus on means returns to focus on. See, average markets have on in the past 30 years markets have been able to give 12 to 14% return. But even you, if the see compounded returns, if you end up getting more than 10%, I think you should be very, very happy. Pick up any flexi cap fund, mid cap fund, or maybe a large cap fund or an index fund, and invest your money at least whatever average returns the market is giving, you will be comfortably able to get. In rural area, people are not able to get proper advice. See, yeah, I was able to see this question in rural areas. People are not able to get proper advice. Let me where was the question? Are not able to get proper advice for mutual funds. Also, they rarely visit online mutual fund site, which is the best place for them to know. Bishwajit, see, this answer I will not be able to answer. Either they have to, it is either they go to the website or they can see. It is you can always ask an advisor. You can always ask an asset management company to conduct an investor awareness program in your place. There are various SEBI registered smart trainers who can come and advise and give, not advice, who can come and give training relating to the financial markets. You have AMCs who conduct investor awareness programs. You have various advisors who also would ask the AMCs to conduct investor awareness programs. So if you are near some kind of an urban or a city, and if there's a financial advisor, or any one of you can go and visit an asset management company and ask the AMC to conduct an investor awareness program in your rural area, then it becomes very, very good. They'll conduct an awareness program. They will give all the insights, and accordingly, some advisors, you can approach some particular advisor. He can come to your place and get the money invested. SIPs also, Harsh Kumar, SIPs also is also possible. How many
Sir,
mutual funds do you
good evening,
recognize?
sir. Sir,
Yes, yes.
another one or two questions, please, because we need to wind up.
Yes, 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 yes. Because the questions are shooting up so fast, I'm
Yes,
not
yes.
able to. Yeah,
So
yeah.
we'll only be able to take maybe one or
Yes.
two
Yeah, I'll
questions.
be taking up one more question, sir. Sir, after maturity, should we continue? After maturity, should we continue investing or else redeem? What do you mean by maturity? Open-ended funds, there is no maturity. Interval plan, automatically it gets matured. Closed-ended fund, it is open. Whenever you want to take your money back, you can always take. Does the NAV of mutual fund rise in price of the equity? It has to be invested in some other way. I could, of course, if the mutual fund scheme has invested in those respective equity stocks, and if the values of the equity rise, the net asset value is going to rise. Okay. Okay. I think. Thank you very much, Rashmeet. Can we wind up?
Please, sir, we'll do that. Thank you
Okay,
so
okay.
much, sir.
Thank you very much. Thank you very much. Thank you. All the best. And you can put in your questions on the email. You can send the questions to the email, and I will try to answer them. Thank you. Thank you very much. All the best.